Good morning or afternoon, and thank you for joining today's webinar, Strategic Options for Distressed Technology Companies. I'm Megan Turco, and I'll be your moderator today. Before we jump in, I'm going to briefly go over how to use your webinar console. The orange arrow on the right side of your screen will let you toggle the control tray open or closed, and at the bottom of the control tray, you'll see a chat window. Please feel free to submit your questions at any time throughout the webinar via the chat function, and we will get to those during a live Q&A at the end. Additionally, on your GoToWebinar console, you should see an area for audio settings. If you're calling in through your telephone, please choose the Use Telephone option, and alternatively, if you're using your computer speakers, please select the Use Mic and Speakers option. And lastly, I do want to note that today's webinar is being recorded. We will send out a link to the slides as well as a link to the on-demand recording of the webinar within about 48 hours. So definitely keep an eye out for that message if you're interested in accessing a recording of the webinar or sharing it with any of your colleagues who weren't able to make it live with us today. And with that, I would like to introduce today's webinar presenters. First up, we have Andres, who is the Managing Director for the Brenner Group, a leading Silicon Valley financial services firm and an Armanino company. He manages a portfolio of approximately 100 venture-backed startup companies and has significant experience managing consulting and financial services projects. We also have Dovile with us today, who is a director also at the Brenner Group. She has a background in strategy consulting and banking and works closely with distressed technology clients in various capacities. And third up, we have Gunther, who is a director in Armanino's consulting practice. He provides M&A advisory as well as valuation services to high-tech companies. Gunther has valued over 400 companies in over 15 years for investment, M&A, financial reporting, and tax purposes. It's great to have all three of you with us here today, and with that, I'm going to pass the presentation over to Andres to get us started.
Thank you, Megan. So before we get started, I want to talk a little bit about the Brenner Group, and of course the Brenner Group, as Megan indicated, is an Armanino company, and Armanino is the approximately 20th largest accounting firm in the U.S. Right now, I think we've got 900 people, getting close to 1,000. And the Brenner Group is an independent part of that. And so we've got, as you can see at the bottom of the slide, we've got roughly 30 consultants and staff. And what we focus on specifically is venture-backed technology companies and technology startups. And there's really three things that we do for these companies. The first one is we provide interim finance and accounting management services. And so what that means is think about the shared economy, Uber, Airbnb, those types of things, but then for CFOs. And so we help clients with a CFO or a controller on a shared basis. We've got roughly about 100 clients in that space at any given time. Restructuring services is the second service that we offer, and that's, of course, what we're going to talk about a lot today. And there's a few different solutions or scenarios that are relevant in that space. The first one is turnaround services, and this is more for companies that catch us a little more early on and that we help navigate through some type of distressed environment and then hopefully get them out of it as well. And so that could be in a function of a chief restructuring officer and in a very consultative approach. The next solution that we offer is a liquidation scenario. So this is really sort of end-of-life solutions for companies. There's two options there. There's wind downs, which is sort of a simple, you liquidate the assets and make sure that you're meeting all your liabilities. And then there's assignment to the benefit of creditors. And we'll talk a little bit about the difference between both of those options. But basically, in an ABC situation, you set up a new company, an ABC company, and you assign the assets and the liabilities to this company, and thus you create a level of legal separation between the original distressed company and this new company. And there's lots of reasons why you would do that, and we'll get into that in a few moments. Next, we have asset sale services, and Gunter's going to talk quite a bit about that, and obviously that evolves usually around intellectual property. Bankruptcies are less, you see them less often here in Silicon Valley. And so Chapter 7, don't see a lot of that. We do see some Chapter 11, and we actually have a client right now that we're navigating through an 11 and relisting shortly on NASDAQ. And then finally, shareholder representation services. These are really consulting services for clients that have sold their assets and have made reps and warrants around those assets. And then typically you go through a certain amount of time in which somebody has to navigate the asset purchase agreement and make sure that those reps and warrants are monitored, and then ultimately make sure that once the money moves from the escrow account back to the selling party, so the shareholders of the original company, make sure that gets distributed appropriately to the right parties, etc. And so we routinely offer that service as well. And then the last service that we offer is, I'm pretty excited about this one. This is new. The Brenner Group historically has not done this, but it's an executive search solution for financial talent. And so think about VP Finance, think about Controller, think about CFO. We help our clients in finding those profiles and making sure they're satisfied. And so that's just to give you a quick little intro on the Brenner Group. So today we're going to talk about three different things. As you heard, we've got three presenters in the room today. And so as you can imagine, all three of us are going to cover one of these topics. The first one, Dovile is going to be talking about, and it's going to really set the stage. And she's going to provide you with an overview of restructuring options and specifically focus on the timeline that's relevant there, and then give you a sort of very easily navigatable overview of restructuring options and really shed some light on, how do you start a conversation like that? What are your options? Next, I'm going to take you through two cases. Now, of course, these are not cases where we can share company names or anything like that, but they are based on real situations. And so it's a very applicable, they're very applicable examples to give you a sense of what your different options could be. And the two cases that we selected, one is an ABC situation and the other one is a wind down situation. And then finally, we get to what's extremely relevant in these restructuring scenarios, which is, well, how do I monetize the assets? And there's really two components to that, and one specifically focuses on intellectual property, and the other one is more, I would say in general, best practices around selling strategies. So with that, I want to turn it over to Dovile, who's going to give you the overview on restructuring options.
Thanks, Andres. Good morning, everybody. So the purpose of this slide is to present a high-level overview of the critical pieces in the organization's life cycle as it enters the zone of insolvency and emerges out of it through one of the alternatives presented here. I would say it's critical to think of 3 to 4 things as we have a discussion about the zone of insolvency. Number one, we should remember that the company is in the zone of insolvency once it starts failing 2 high-level tests, a balance sheet test and a cash flow test. Balance sheet test is very simply a time at which the company's liabilities exceed the assets, and the cash flow test means that the company can't meet its financials obligations as they become due. The other critical piece to remember is that at this point in time, we're at this point of the traffic light here on the slide, and so the strategic investor is made a decision to discontinue financing the company, and so the board now makes a decision to proceed with one of the options that we've outlined here. For avoidance of any confusion, at this point the company is past the stage of typical follow-on financing rounds. So when we're talking about alternative financing scenarios here, or any scenario outlined here, it's really the quote-unquote rescue option or salvage option that the company has. So moving on to the next critical piece to remember when in the zone of insolvency is the role of the board of directors. and specifically the fiduciary duty that the board of directors owes to the various constituents within the organization. Now, what does the fiduciary duty actually mean? It means that the board of directors must act in the best interests of the corporation and its shareholders. In solvent companies, the fiduciary duty is to shareholders. Once the company becomes insolvent, though, the fiduciary duty expands to the creditors as well as the shareholders. And so the board of directors must always keep that in mind as it navigates through the company's situation in the zone of insolvency. And when making financial decisions, it must always apply the business judgment rule, which pretty much asks whether the directors were acting in good faith and the best interests of an organization when making financial decisions. So to make this a little bit more relevant and easier to digest, imagine that a question comes up as to whether the company should invest in NetSuite. And so the board must ask itself, does this satisfy sound business judgment? And will it benefit the shareholders? Will it benefit the creditors? And this is not an easy question to answer. And that is a very good point at which time the board should engage with outside third-party experts such as insolvency counsel or a restructuring specialist such as the Brenner Group to help them in making these decisions as they come along them. Okay, so at this point in time, let's pause here and take a polling question. Megan?
Thank you, Dovale. So we'll get this first polling question up on your screen here momentarily. So the question is, do you think your company has been in the zone of insolvency? This one's a pretty easy yes or no, 50% chance there. So it's really your own company's experience, obviously, no right or wrong answers. We'll give everyone just a few more moments here to actually answer the question based on, obviously, Dovale just sort of explained some of the parts behind the zone of insolvency. So we'll give everyone a few moments. Now would be a great time that if you do have any questions that you wanted to submit for Q&A based on Andres' introduction or some of what Dovale's already covered, you're welcome to submit those as well. So we'll go ahead and close the poll in about 3, 2, and 1. And we'll pull those polling answers up here. It looks like most of you said no. So Dovale, I'll pass it back to you to chat a little bit about that.
Sure. Thanks, Megan. Thank you very much for submitting your responses. It's interesting to see that, not surprising necessarily. So we see that the majority of the respondents believe that their company has not been in the zone of insolvency. And I think this highlights the grayness associated with the situation and the complexity of the matter. So what could happen oftentimes is that the company is simply unaware that they're in the zone of insolvency. And so it's critical to remember that the monitoring from the very get-go of the company's financial situation and talking to the outside advisors, having a solid, experienced CFO on board to help you monitor the company's financials becomes critical. Because like I mentioned, let's revisit again quickly the tests that the company is constantly evaluating, the balance sheet test and the cash flow test, so the liabilities are exceeding the assets. Once you're failing the balance sheet test, and the cash flow test focuses on the organization's ability to meet its financial obligations as they become due. And so these two should be monitored at all times. As well as the fiduciary duty must be observed at all times. And so you really have to be very vigilant about observing this duty because once the company enters insolvency and creditors or any other constituents sort of start coming after the board of directors, you will need to be able to go back and show that how you were exercising sound business judgment in your operations.
Yeah, I thought I'd throw in quick here, this is Gunter. A lot of startups, these liabilities are not necessarily on the balance sheet. So think about lease liabilities, think about accrued vacation for personnel, which usually at an early stages is not even on the balance sheet. So, but it is included in the test for the zone of insolvency.
Thank you, Gunther. Good point. All right, so moving on now, let's focus a little bit on the lower part of the slide here and talk a little bit about the options once the decision is made to proceed with one of them. So you can see here at a very high level, this very much depends on the length of runway a company has remaining at this point. So if you have 6 to 9 months of cash remaining, you will have one of the first 3 options available to you. And once you have less than 6 months of cash remaining, you're really in this panic mode and you will be considering the liquidation or bankruptcy scenarios. So alternative financing, going back to option 1, is the easiest option, and then selling company through M&A allows to pay proceeds to investors is of course favorable option as well, and an asset sale could be a good option to recoup partial or full asset value of the company's assets. When you have less than 6 months remaining, you will be looking at an ABC or an orderly wind down, by the way, for clarity's sake, ABC stands for Assignment for the Benefit of Creditors, and that is essentially a trust created by contract. And in that case, the company assigns all of its assignable assets to a third party, a separate entity. In the case of an orderly wind down, there is no such assignment required, so the process is a bit simpler, and we'll talk about that on the next slide. On average, I just want to point out the company will pursue an orderly wind down when there is enough cash to pay off liabilities, and you will go into an ABC scenario when the creditor payments exceed the available cash. And I should again preface this that this is on general trend, and we will discuss that further on the next slide. And Andres mentioned we don't see a lot of bankruptcy cases, Chapter 11 a bit more frequently than Chapter 7, but they do happen once in a while. And finally, walking away is an option. However, it's not a good option because there is no such thing really as running away. This will haunt you, and it's certainly not advisable. So this is a high-level overview, and now let's move on to the next slide, which shows you a different way to look at the options we've outlined from 4 different perspectives. So public visibility, cost to shareholders, the speed of the end-to-end process, and D&O liability risk, as well as value for creditors and shareholders. And D&O stands for directors and officers. So you can take a look at all of the detail within the slide at your spare time, but for the purposes of today's discussion, I'll just give you sort of an easier way to digest this. So severity of all these factors increases as we move from the left-hand side to the right-hand side of the slide. And the key differences here to point out would be the difference between the out-of-court liquidation in ABC versus the bankruptcy scenarios. And so the bankruptcy scenario will come at a higher cost, predominantly due to the fact that the legal process is involved. You're introducing a third-party trustee. A creditor committee, all of which will exacerbate the situation and make the factors more severe. So when contrasted with bankruptcy, liquidation and ABC options are relatively smooth because the debtor in this case can pick the assignee in the ABC scenario. There's also less public visibility, obviously, if this is out of court. And the trustee that the debtor will assign in the ABC scenarios is more likely to have more experience in going through an asset sale, for instance, and so will be able to recoup better value. And then if we go into the difference between an orderly liquidation and ABC, again, I will reiterate that the key difference lies in the fact that in an ABC option, the operations of the company are transferred to an independent third party through a formal process. And no such formal process takes place in an orderly wind down scenario. And of course, then the question becomes, well, why would a company go through the ABC if it's faster? And again, so here we'll reiterate, that simply means that you're probably further down the downward spiral at this point in time if you're choosing to go through an ABC, and there's probably some sort of aggravating circumstances in the deal. And that could, for example's sake, mean that you're trying to sell assets to an insider, you have very complicated creditor makeup, and so creating this separation through an ABC will give you an extra layer of protection. And so effectively an ABC will come with slightly lower director and officer risk from D&O liability standpoint, as well as the shield from public eye. So I think this would be the end of the summary, and Andres will now take you through restructuring best practices.
Thanks a lot, Dovile.
You're welcome.
So that's a great overview, and it really sets the stage. And then let's dig into some real life examples. And like I indicated, these are based on actual client situations, but obviously we had to change some of the details here. So this first one, very interesting case. This was a wearable device company, and of course there was an app associated with that as well. And wearable devices over the course of 2015 became a very hot market. This company became a very hot company. It was really, I would say, one of these sort of Silicon Valley darlings. They raised $30 million fairly easily, had some very prominent investors. And once you went a little further down the year, and investor appetite in Q4 really started to slow down quite a bit in the space, at that point investors and board members and management teams were really looking more at, well, from a profitability point of view, where do we stand, and is there a clear path towards profitability? And this company and of course many others didn't really have a clear path towards profitability. Now, this was probably in December, I think. Management came to meet with us, and we discussed all these different options with them. And management really believed that there was a way forward with this company. They strongly believed that the hardware that was created, and I would say the IP behind that hardware, was very valuable and really had a future. And they were interested in acquiring the assets themselves out of the company. And so this was an insider situation, as Dovile indicated. So you would really lean towards an ABC type of solution. Now, the other side of the equation here, when you think about the balance sheet, was that on the liability side, these guys exceeded the assets, and I would say beyond that, they probably waited too long to consider their different strategic options. And so what they had to do was effectively provide short-term financing for their own company out of their own pocket. And the way they did it was not by increasing equity, but by, in fact, providing a short-term bridge loan to the company. And the short-term bridges are not unusual, I would say, but the terms of them can be fairly aggressive. And the reasoning behind it, of course, being, well, these are high-risk short-term investments, and so they should have a high yield on them. And so the terms that these guys negotiated on this insider debt piece were a guaranteed 3x return upon monetization of the company or the assets of the company. So a lot of sort of tricky situations combined in one company. And so here you really had to separate the assets of the company out of the original company. And so setting up an ABC and making effectively consultants of the Brenner Group, the directors and officers of that company, creates a level of legal separation and of course, makes us have that fiduciary responsibility and the liability that comes along with it. So we set up this ABC company and assigned the assets and liabilities to the company. And next we went through an auction process in trying to monetize the assets here. And the auction process was very successful. We were able to sell the assets for $6.6 million. And we went through a process that took about a month. Now this is a very accelerated time frame. Usually, and Gunter's going to talk more about that, but usually it takes us 90 days to do a proper process. But given the accounts payable sort of increasing danger situation, we really tried to move as fast as we could in this situation. And so we had 2 soft auction dates and 1 hard bid date, and took the company through a very transparent process, which led to that $6.6 million monetization of the assets. So why is that $6.6 million so important? Well, the $6.6 million really allowed us to meet all the existing creditors, all the outstanding liabilities there. And so we had the $3.2 million, which was unsecured, which we were able to fully pay off, and we were able to pay back the $1 million bridge with that 3x guaranteed return, as well as any outstanding accounts payable at the time. And so what this did was it avoided a situation where potentially some of these unsecured creditors would have felt like that 3x guaranteed return was a situation that was sort of creating enough, I would say, enough data to really create an environment where litigation would have happened, or where potentially bankruptcy court would have looked at this and reclassify the debt as really being an equity investment. But because you're able to satisfy all the creditors, no one has reason to sort of further pursue that, and it doesn't happen. At that point, what happens is it becomes a discussion that the equity holders have, because the existing equity holders in the company, of course, then don't see any of the asset monetization proceeds. Now, if you're in a situation like that, and so if you're an insider and you're considering extending a loan to the company and using that as bridge financing, just make sure that you are exhausting all external options before doing so. And so talk to any venture debt, any Silicon Valley typical lender, any banks, any third parties who might be interested in providing you with short-term financing, and document the process. And so just really try to make sure that you're going through a normal business process there, and people can sort of look at this and say, well, reasonable judgment and reasonable effort was applied, and reasonable judgment ultimately in making the decision here was applied, and that covers yourself. The other side of this transaction, so the asset sale, I have to note, was actually not done to the group that was led by the former management. And so it was sold to another party. We had 3 parties in this transaction. And ultimately, of course, it's our responsibility to really think about in this situation, well, what's going to benefit our creditors the most. and that has nothing to do with whoever the former management was or whatever the relationship might be there. And so that was sort of an interesting piece to this transaction as well. And so then the last step, of course, is that you want to do a final dissolution of both the ABC as well as the original company. Okay, so with that, we're going to take another polling question.
Thank you, Andres. We'll go ahead and get that polling question up for everyone in just a moment here. It takes just a sec. So our second poll is, I think a normal return on short-term high-risk bridge debt financing should be, and your options are 1.5 times, 2 times, or 3 times. So we'll give everyone a moment here to get their answers in. Again, no right or wrong answers, just your own thoughts on this. And then Andres will go ahead and cover his perspective on your answers, of course, after that. As I mentioned last time, now is a great opportunity to enter in some questions for the Q&A happening at the end of today's webinar. If you have any questions based on Andres' comments, or of course the comments from Dovile earlier as well, that's an option. So we'll give everyone just a few more moments here to get their answers in. And then we will close the poll in 3, 2, and 1. And we'll get those answers up on our screen here for Andres in just a moment. It looks like it's a little bit spread out between 2 and 3 times there, Andres.
Thank you, Megan. And I would say that's very much in line with what we see in the marketplace. 1.5, I'd probably say that seems very low for such a high risk investment. 2x actually was very common last year, and this year we've seen a lot of 3x deals. Curious to see if that moves any further. Now, of course, keep in mind, I think in this example, as well as anything that we talk about today, it always really goes back to the situation. And if you've got a balance sheet that's already highly leveraged and very, very low risk of return, and obviously that X is going to go up. But great polling answers there. Thank you so much for participating. All right, so moving on to our next case study, a little different. The biggest difference here being that the assets, in fact, exceeded the liabilities by the time that we commenced our process of an orderly wind down. And this company was in the money transfer business, and so they had both a hardware as well as a software component. They had these transfer terminals that you would find at 7-Elevens and things like that. Oh, you got a little earthquake happening here in San Ramon. All right, seems like that was just minimal. Anyway, so going back to the case, this is really a small earthquake, I think, right? I mean, or a big truck that might have just hit our building or something. But yeah, so money transfer terminals that you would find at 7-Elevens, and so what they tried to do was really find a solution for people who didn't have access to, whether it was credit cards or international wiring instruments, and sort of give them a shortcut to wiring money to one another using these terminals. And so this company raised about $58 million in 5 rounds, and found themselves at this strategic decision-making point, as Dovile showed in her overview slide, that little traffic light, and they ultimately decided, you know what, there is no clear path towards not just profitability, but ultimately the returns that we promise to our investors. We still have assets that exceed our liabilities, but we feel like this is the right time to pull the plug on it, and it's just not going to happen. And we're sitting on a number of assets here that if we monetize them now, can really create a good amount of sort of a good outcome for our initial investors. And so we went through an asset sale and an orderly wind down. And when we do that process, what a lot of times ends up happening is that also there we take over the director and the officer role. So let me take you through the mechanics a little bit of the situation here. So we sold the IP and the assets over the course of 2015 and 2016. Of course, we played a role there as the shareholder representative, and so managing the those sales proceeds through an escrow period and making sure that the reps and warrants that were made with regards to the sales proceeds, following up on them and seeing to what extent claims are made against the escrow from whoever the buying party is a role that we routinely take on and that we did in this situation. Now, there were a few unique aspects, I would say, to this situation. And so we had an outstanding employee lawsuit. There was one of the members of the management team was promised that they were going to have a position at the new company, at the acquiring company, and they didn't get that position. And so they sued the former company, and so we had to settle with them and find a solution. There was a multi-year tax assessment that in a number of states was not done, and so the buying party goes back to the selling party and says, hey guys, you should really be picking up the check for this. This is previous year's tax work that wasn't done. This is not our responsibility. And so that's typically an example of something that would be a claim against the escrow and ultimately reduce the total purchase price. There were lease charges, and so this company had to get out of a number of leases, and I would say the standard rule in that situation is that you have to really think about what are any costs that my landlord could be incurring as a result of me terminating this lease or trying to get out of this lease prior to its expiration. And then finally, there was a class action lawsuit. I don't know if it was filed or if it was pending, but I do remember we had to settle with them. And with a lot of these, this is not something necessarily that we do alone. We very much involve corporate counsel as well as insolvency counsel in this instance. And so all creditors were satisfied. That's always a good outcome, but even more so, the investors received the remaining proceeds, and so they see some return on their investment. And then as a final step, there's a simple dissolution of the company. With that, I'm going to turn it over to Gunter, and he's going to talk about monetizing the intellectual property.
Thank you, Andries. So I will talk about how to monetize the IP, usually patents, but not necessarily only patents. And in a lot of these technology companies, really the IP is the most valuable asset. So there might be equipment, there might be office furniture, but really the value is in the IP. I'm with Armanino Corporate Finance. I head up the corporate finance activities here, which is a continuation of what we did at the Brenner Group. The services that we provide is sell-side advisory, so sell-side representation for companies, buy-side advisory, also IP sales. And this is mostly what I will be talking about today. We have a highly structured, formalized process, Auction 90, where we go from start to finish in 90 days. So it's a defined term, which is important in these situations to find closure to investors, but also creditors. And we act as a purchaser representative. That usually comes up when companies get bought and the buyer pays in shares that are not registered. So to satisfy SEC regulations, you need to be either accredited, or if you're not accredited, you need to be sophisticated, which often you do with the help of a purchaser's representative. We have a team of 12 industry analysts, so we do cover high tech, which I will mostly be talking about today, but we also cover more traditional industries, food and beverage, manufacturing, industrial. So when we get called in for an IP sale, there's usually two scenarios. One, the company tried to sell, but it did not succeed. So we sell as an asset sale or as an IP sale. or there is some very specific adverse event. So maybe there's a hiccup in the FDA approval process for another earthquake here.
This is all live, folks, so we you get to deal with the earthquakes.
There might be a hiccup in the FDA approval process, so think about a medical device company where something went wrong in the trials. There might be insufficient customer traction, or there's a technology development snag. Maybe a semiconductor company, they need another spin on their chip. Usually where it comes down to is they failed to get follow-on fundraising, or they're over-leveraged and the bank pulls the plug. And then you have, like Dovile pointed out, you have two main options. You can sell as a going concern. Usually that takes more time. Or you have a liquidation sale where you sell on the one side the hard assets and on the other side the intellectual property. Often this is bifurcated because the buyer of the hard assets, of the equipment or office furniture, it's a very different breed than the buyers of the intellectual property, which is typically patents, and usually we sell them as in an auction. So who is buying this IP and why are they buying? So one is to buy as a going concern, or sort of going concern if it's already in restructuring, and that can be existing partners or it can be new prospects. Existing partners have the advantage that they have done some kind of due diligence on the company, so they're familiar with the product, with the IP. Often they can do a vertical integration where they take this IP into their existing company. New prospects will take a little bit more time, so they need to do their due diligence, which is much more streamlined in an IP sale if it's patents. Why are they buying it? Well, it could still be a business, but at a scaled back ambition. So a software company could still be an open source software. So you could take it open source and build a consulting business around it, which has value, just not the same value as if the company had succeeded. Or it can be coupled with buyer-specific synergies. So it can be a product feature within a larger offering of a buyer. I should add here also that, well, sometimes companies buy the IP just to prevent it from getting in the hands of their competitors. So it's a more defensive position. Especially when we talk about patents, we look at offensive uses and defensive uses. So offensive is you're trying to enforce the IP against a company that may be infringing. So you have the non-operating entities, or also known as the trolls, patent trolls. But you can also have operating companies that want to gain a competitive advantage against one of their competitors. Defensive purposes might be operating companies, could be somebody that got burned and they need to shore up their patent position because when the next litigation comes around, they want to have something in their quiver. But it can also be non-operating entities. These are usually patent trusts that have multiple members that band together and take patents off the market, then license these patents to themselves so that they can't be sued in the future, and then throw them back onto the market for somebody else to enforce it. And then we have third-party enforcement companies. Usually these deals are structured as a joint venture where the third party is enforcing the IP and trying to reach some licensing agreement with a third party. In regards of maturity of IP, what we see is, and probably in increasing order of value, patent applications, then granted patents, then patent with a product attached to it, and then even better, but not necessarily the case, is a patent with revenue, with a revenue generating product attached to it. And then really because it also attracts a whole different set of buyers is patents that are infringed upon. So again, you might have somebody who buys it for offensive or defensive purposes. Some other aspects is patents can be very narrow, so they can be very application specific, or they can be very general. We had one case, a medical device company, and they had about 30 patents. 29 of them were very specific to their application. Now their product didn't meet the FDA endpoints for their trials, so they couldn't pursue it any further, but they also had one a general patent on a nitinol, so nickel titanium composition, and that is very broadly applicable, and in the end that was bought by a company for defensive purposes. In that regard, more patents isn't necessarily better. It's really how can they be applied, and is the product still on the market, or are there other products that can benefit from that? Then consider geographies. Some of the Asian buyers, they would want to have it patented in Asia, so they want coverage in those countries. They might not be even interested in US or in Europe, or not until much later. Another aspect is you need to consider maintenance costs during the sales process, and two aspects on that. One is if there are office actions from the patent office during the time of the sale, you need somebody who can reply to those and manage those, and there might be maintenance fees to keep the patent alive during the process. So how does this look like? On the left side we have negotiated sales. This is usually done in M&A transactions where the company is sold, and usually you don't want the whole market to know that the company is for sale, so it's a very confidential process, usually less than 5 prospects. Usually you would not talk to your competitors, or not until very late in the process. And then moving to the right is targeted solicitation. There we would talk to 30 to 50 high value prospects, usually to the usual suspects, and the thinking there is, well, if they don't buy it for a reasonable amount, then probably it's a case for a full-scale auction on the right. This is where we want to clear the market. We want to talk with everybody. We want to talk to competitors. We want everybody to know here's some IP for sale, and this is what we do in patent auctions. And we have developed a highly structured sales process for that, 90 days from start to finish, so it has a defined term, and it's usually used for asset sales, or really any sales where the due diligence is rather streamlined, and where there's not a lot of need for negotiating a comprehensive agreement. So usually these are asset sales agreements, and there aren't a lot of reps and warranties associated. It's usually sold as is, specifically for patents, with very light reps. And 14 days after we run the auction, we get to closing. Some other considerations, one on timing. So IP can get stale quickly, and that has mainly 2 reasons. One is, well, technology advances, so maybe it gets overtaken. Other companies design around the patents, and the other is people. The more the people find new employment after a restructuring situation, the harder it will be to sell the IP. But on the other side, sometimes it can pay to wait. We had one case. This was a semiconductor company. They had a product for the automotive market. They had a good solution, but they needed to respin their chip, so they needed to raise additional money, which probably wouldn't have been difficult, but it was 2008. So 2008 was not a good year for the automotive industry, and also not for the semiconductor industry. So the bank foreclosed, but they didn't try to sell it right away. They sat on it for a while, and we sold it, I think, in 2011 for a pretty good return. Second is role of people. So you need folks to support the sales process, to support due diligence, to explain the technology, the uniqueness. Often you need folks in a post-sale transition period and monetization. So if there's continued product development, if there's integration, if those folks are not available, it usually has a dampening effect on the price. And interesting enough, if it's an offensive interest, so somebody wants to pursue the patent and enforce it against somebody who is infringing on it, usually it is advised if the founders are still involved, because it just makes the story stronger. It's not just a patent troll, but it's a company that is looking for help in battling the infringement. If possible, you want to have multiple buyers, so you might be able to do non-exclusive licenses on multiple parties, maybe carve it up by geography, application, or you can carve up the portfolio in different families. And with that, I'm going to launch the next polling question.
Thank you, Gunther. So our last polling question today is, buyers of intellectual property can be, and your options are partners, competitors, companies in adjacent industry segments, non-operating entities and defensive trusts, or all of the above. So go ahead and submit your answers for this one. You've got obviously a few more options than the last two questions that we had. But this is, as I mentioned, our last polling question of today, and then we'll let Gunther wrap it up a little bit and conclusion from Andres and move on to our Q&A. So, of course, as always, if you do have any questions that you'd like to submit from the three segments of today's webinar, feel free to go ahead and submit them now. And we'll go ahead and give everyone a moment here, and please get your final answers in. And we'll close the poll in 3, 2, and 1. And I'll pass it back to Gunther to discuss the answers. It looks like everyone is on the same page of that one.
Yeah, not much to add to that, other than it's important to look at all the possible buyers.
Great stuff, Gunther. Thank you. So in conclusion here, a couple takeaways. So make sure to consult outside advisors early on when in zone of insolvency. And this is really just to keep you out of trouble. You got to always keep in mind a bankruptcy court would look at this and make sure, you just want to make sure that what you're doing is what a prudent business person would be doing, sort of going back to that business judgment rule. Apply extra sensitivity in contemplating an insider transaction, very important one. Transparency and documentation are key, and it goes hand in hand. And then in the asset sale process, think big picture. As Gunther mentioned, there's different applications to buyers that you might not be thinking of. And then finally, you want to be conscious of all potential buyers of intellectual property. So it sort of goes back to the offensive versus defensive categories. Okay, well that wraps it up. So we have, I believe, about 5 more minutes for questions. So I was wondering if any questions had come in. Megan, I think we had maybe 1 or 2 questions that came in earlier.
Yes, we do have a few that came through. So the first one, and Andres, I think that this one might be directed at you, but of course all 3 of you are welcome to share some input. What is the typical outcome of a dispute with the landlord on getting out of a lease?
Yeah, I'll take this one. So as I indicated earlier, it really comes down to when a bankruptcy court would look at this, they would say, well, what was the loss that the landlord incurred in going through a change there, and that change, of course, being created by your early termination of the lease. And so think about a situation where, you know, if you're renting in some kind of really expensive space in San Francisco right now, you're probably paying about $100 a foot a year, unfortunately. But if that's what's locked in your lease and the market goes back down to $90 a foot, well, then the loss that your landlord is going to incur is going to be significantly higher. And so, you know, think about what's the marketability of your lease, and if it's very marketable, then you're probably looking at 3 months at a minimum. But if it's not so marketable, then it could be more than that. It's got to ultimately be a solution that's negotiated and that's settled between the two parties.
Thank you, Andres. Dovile, I believe that this one actually came in during your section. What is the board approval process for restructuring options?
Sure. For the approval process for bankruptcy, only board approval is required. In the assignment for the benefit of creditors, board approval and shareholder approval is required, and the same applies for the wind down scenario. I hope that answers the question.
Thank you, Dovile. We do have actually one more, and actually it works out quite evenly. We've got one for each of you. Gunther, I believe that this came in during your section as you discussed various patents. So the question is equipment always sold separately from patents?
Short answer is no. Often it is sold separately, just because there's different buyer categories. But if the equipment supports the patents and the intellectual property, then it may be sold together. So we had one case a couple of years ago where, I mean, the office furniture was auctioned off. A lot of the IT equipment was auctioned off. And there's specialized companies that buy these, but we retained some of the testing equipment because during due diligence for the IP, and this was also a chip company, folks wanted to review those tests and do their own tests. So we moved some of the equipment out of the facility, closed the facility down, and put it into a co-location facility, and there we had due diligence meetings with some of the companies that were interested, and we could support that way. And then, of course, if it's an operating entity and you want to sell it as an operating entity, then you would sell it with most of the equipment. But often the buyer has their own facility, so usually office furniture, a lot of the IT would be sold separately.
Thanks, Gunther. So that does wrap up most of the questions that we got in today. I do want to make sure that we get everyone out on time. As a reminder, of course, if you missed any of the content, or if you'd like to share it with any of your colleagues who weren't able to make it live on today's webinar, we will be sharing both the slides, a link to the slides, and a link to the on-demand recording of the webinar within about a day or two, so definitely keep an eye out for that message. That does wrap up our Q&A session today. If you do have more specific questions, feel free to contact Andres, Dovile, or Gunther directly. All of their contact information is up on the screen, but of course you will get that in your email, so don't need to worry about writing all those down really quickly there. As you exit the webinar today, there is a quick survey, so definitely take a moment to let us know your thoughts on today's webinar. And thank you very much for your time. Thank you to all three of our presenters today, and have a great rest of your day.
Thanks, Megan. Thanks.